Hi, I'm Mike Thomas, Care Training Lead here at GAF. If your house has been damaged in a storm, understanding your insurance and working through the claims process can be complex. In this video, I'll explain what insurance depreciation is and how it is calculated. One thing important to know about a homeowner's insurance policy is that everything, your roof, your laptop, furniture, and so on, is assigned a value and may lose value over time due to factors such as age, wear, and tear. This loss in value is commonly known as depreciation. Why is depreciation important? Because most people who file claims against their homeowners insurance policies are reimbursed for the actual cash value of their damaged property. Actual cash value is not the same as replacement cost value. Replacement cost is just what it sounds like, the actual cost to replace an item in pre-loss condition. Actual cash value is replacement cost minus depreciation. Generally, depreciation is calculated by evaluating an item's replacement cost value against its life expectancy. Here's a simplified example. A $1,000 refrigerator could potentially depreciate at 10% a year under normal conditions. If the refrigerator is 5 years old at the time of your loss and it requires replacement, the insurer may subtract 50% depreciation, 5 years at 10% a year, from your replacement cost estimate to determine an actual cash value of $500. For more details on these coverages and other important storm-related questions, please check out our other videos in this series.